Welcome to Real Estate 360 Live with Ryan Sloper, the trusted name in real estate radio. Now, here's Ryan Sloper.
Welcome back, everyone, to another episode of Real Estate 360 Live. For those of you not familiar with the podcast, my guest and I will cover all angles of real estate, from interest rates to the economy to what's happening in Washington. If you're listening and tuning in regularly, I appreciate you tuning in, and also I appreciate if you would download, subscribe, share the podcast so we can continue to grow the audience, to get the word out there. What's taking place with the Federal Reserve, what's taking place with Congress, and internationally, all the different things that we hear about every day on the news, whether it may be radio, newspaper, TV. We're going to break those things down and let you know what effect they're going to have on you, not just you and what's going on in your house, but we're going to talk about the credit cards and savings and mortgages and interest rates and the dollar, all the things that many don't talk about. I've had a lot of interesting conversations over the last couple of weeks, primarily around the podcast, and just people saying that I've been pessimistic, and we talked last week where I said it's just more of a realist view that just happens to be pessimistic because of the circumstances that we have right now, and the Fed is obviously overly optimistic at all times. Joining me on our panel, as he does each and every week, is Louis Camerasano, a former school teacher, a former attorney, and a former general manager of a major real estate portal. He's been cited in the media as a real estate industry expert in Wall Street Journal, Forbes, Fox Business, U.S. News, MSN, and numerous others. Louis, how you doing today?
I'm doing grand, Ryan. How are you?
I'm doing well, sir. Great to have you back on.
Excellent.
We talked a lot, last week. Drink there, get a little sick. Last week about, the Fed and the meeting that took place. Now the minutes have been released from that meeting. Essentially, no surprise, they're going to continue to remain patient. They're going to leave the key interest rate unchanged. Economic activity has expanded. The labor market's improving. Household spending rising due to lower energy costs. The vote was essentially unanimous. Basically the same exact statement as last time. Okay? Now, we do know that Yellen has basically came out and now is starting to shift her attention internationally. She stated that, potential fears abroad. And I think that is the setup for exactly what we talked about for their next move. They'll start to gradually pull this international fears and global uncertainty into the mix so that they have a reason to continue to print more money. Would you agree with me there? And I just wanted to get your overall sentiments on the latest Fed meeting and the minutes that were released.
Well, sure, Ryan. What they've done is exactly as you said they would, and we've been predicting all along. They will come up with some reason not to raise rates. They'll come up with some reason to keep interest rates low. And in some say, and I think we're in this camp, that they will come up with some reason to turn the printing presses back on, because you cannot have the European Union engaged in $1 trillion money printing exercise, the Bank of Japan doing the same, with the dollar skyrocketing. That will just create what the Fed calls deflation, which is supposedly the worst thing that can happen to an economy. So the Fed really can't raise rates. I think what they're doing is they're talking it up, the dollar, so that when it falls, when they have to do QE again, it's up pretty high and it's not a disaster. But there's absolutely no way. I mean, they might even, we talked about this during the taper. They might actually do a rate increase just for credibility's sake, just to get one under the belt, because the Fed, had they come out in 2009, Ryan, and said, okay, here's what we're going to do. The economy's a disaster. We are going to print $4 trillion, buy mortgage-backed securities, 70 to 80% of all the U.S. newly issued treasuries for the next 6 years. Now, had they come out and said that, the dollar would have absolutely collapsed. But that's exactly what they did. But the way they did it was they did QE1, then they stopped. They appear prudent, and they said, we better do QE2. They stopped. They look like they're prudent. Then they do the biggest one of all time, QE3. Then they stop. It looks like everything is working. And now, if they have to do QE4, well, if they put enough space in between QE3 and QE4, and it looks like the economy had recovered and that QE had worked, that QE is now a viable Fed tool, if you will, to improve the economy. So, and everybody else is doing it, so why shouldn't we do it? And I think that's what's going to happen is they will use whatever excuse with the pretense that we're never going to do it again. But, this international global uncertainty, strength of the dollar, unexpected, and also the stock market will go down and the economy will start to decelerate. Because the other thing, Ryan, is I had done a chart about a year or so ago that showed that the growth in GDP, forget how you don't even have to believe that the GDP numbers are legitimate, but whatever GDP growth that they showed was less than the amount of QE that had been pumped into the economy. So we know that, if history is a guide, that whatever QE they stop, well, we're going to lose some of that in future GDP. So as the GDP decelerates, as we saw in the fourth quarter, down at 2.5, and a large amount of that is Obamacare spending and other ridiculous spending that shouldn't be included in GDP, it'll decelerate further in the first quarter. So by the second and third quarter, it'll be apparent that the U.S. economy is decelerated, not because the economy isn't sound, but because of, as you say, global international uncertainty, companies, American companies getting hurt by the improved value of the dollar, and therefore, Ryan, they won't be able to raise rates. Or if they do, they'll do it just for credibility, and that'll give them all the credibility they need to bring rates back down to zero when Europe is going negative, and for them to start QE4 all over again.
Yeah, I think you're on to something there. I think when we were talking before, when they started to pull back on QE3 and they continuously, they kept talking about tapering, and they finally, to establish that credibility, they had to continue to do it and phase it out, right? But they have never stopped reinvesting what was already put in. They just stopped putting new money in.
And they found other buyers. Also, because if Europe was going to do QE on their own, that also made the dollar more attractive and U.S. bonds more attractive because they were the ones that actually had a positive yield. So then the Fed didn't have to buy the bonds anymore.
Right, exactly. And
central bank coordination.
They've been talking now forever that we're gonna raise the Fed fund rate sometime potentially this year now. So if they keep saying it and at some point don't deliver, things are just going to get much worse. So I think you are right. I think they might throw out a 0.25% rate maybe late this year, right? And that would be a signal going, I could see that being a signal to the market that, it looks like we've really turned the corner now. They've raised the interest rate. Now, I don't think they can budget too much just because, as we mentioned before, one of the main drivers of all this, they can't pay back the debt that's been issued out here if they start raising interest rates up. So they can't let it go too high, in my estimation. I wanted to play. You remember how we talked last week, Louis, about the interview on CNBC with Mark Faber? Did you catch the one? Did you catch the one with David Stockman this week?
No, I didn't.
Okay, I'm going to see. Hopefully, you can hear this. I'm going to turn it way up. She's a former OMB director who's on the phone with the same girl from the previous week that had Faber on. And
Jackie DeAngelis, Smirking Jackie.
Yes, Smirking Jackie. So listen to this. It's a real treat.
I think it was gibberish. I mean, it was pathetic. After 73 months of interest rates, these folks in the Eccles building do not have enough gumption to allow rates to rise even by a smidgen. As far as I'm concerned, they're not central bankers. They're really spineless cowards who are petrified of a Wall Street hissy fit. That's the only reason for zero interest rates. They don't do an iota of good to any household or business in America. The difference between 12 basis points where it is today, the funds rate, and 25 or 50 is a rounding error, noise, and irrelevant. All of this is about keeping the bubble going, keeping the speculators in their free carry trade.
Jackie's shaking her head right now, by the way.
Yeah. And it's going on worldwide. Every other central bank is doing
it as well. Yeah.
Right.
So, and there are a lot of people out there that would certainly agree with you that the Fed is propping up this market. My question to you is, even if this is sort of a fear-driven action on the part of Janet Yellen, how much longer can it last?
I think we're nearing the final innings of this because worldwide central banks are now in a desperate battle against the very deflation that the earlier financial boom and money printing time, all of this zero interest rate, cheap money, QE, caused a desperate scramble for yield worldwide by investors that led to massive overinvestment in everything. Shale and the...
Now, guys, remember, CNBC and most of these other networks, their whole goal is to continue to pump stocks, right, to keep the market moving. And it's just comical when they have these interviews that are, as you stated, Liz, they're bringing these people on just to say that, that they're to have the commentary, but they really want to bash them, right? They want to find a way to flip it on them and ask them questions that completely discredit what they're talking about. And everything she comes back to, with no matter who she has on there, is basically, asking, well, why is the market still, rising? Why is the stock market still going up? And interestingly enough, it's the only reason the stock market is going up is because the Fed and what the Fed has done here. This is,
right.
An artificially created stock market, an artificially created market in general. It's completely so far blown out of proportion. I can't even begin to explain to people the magnitude of what the Fed has done here with the amount of money that's been printed or added onto bank balance sheets, that allowing big banks and the rich to get richer and allowing for the middle class to push to basically the lower class. And we talked about this is exactly what happens when you create this. They don't really want the money, all this money, in the hands of your everyday people. They don't want that. That's not what the whole goal of QE was. And it has been 100% ineffective at what they set forth in the beginning, Louis, like you said. Why do we continue down this path? Only because that's what they have to do. What they have to do. We talked about kicking the can down the road 5 years ago, Louis.
Well, once you start kicking it, it's not like kicking the can down the road because you're trying to avoid the pain now. It's the further you kick it down the road, the further the point of no return you go.
Absolutely. And I think that we've started realizing now is all of a sudden, maybe these numbers that they're making up every week, for instance, we'll go through this past week. Let me pull up. So we've got preliminary fourth quarter GDP report was 2.6% versus an estimated 3.0 to 3.2. Of course, right off the bat, they say it's going to be revised. The number will be revised two more times. So it's not going to probably end up being that big of a disappointment. It'll end up lowering down one and going back up. Consumer spending portion was pretty good at 4.3% versus 4% estimate. Now the big push is, since everybody's saving money on energy costs, Louis, now they're going to have more money to pump back into the market.
Right.
Well, great. That doesn't matter to me. It's either being spent on energy or something else. It's not like there's more money being made.
Correct.
Because
consumer incomes are not rising.
No.
Expenses are rising, and that's why people are spending more, because they're spending more on health care. So you lower the cost of gas. Sure, they have a little more money, but not because they have more money, just because they're not spending it on gas. They've got to spend it other places, like increased insurance costs. And food costs have gone up.
Of course they have.
Well, other people don't realize that food costs continue to rise even though the CPI is going down, the Consumer Price Index. And that's where most people, the bulk of people, the most number of people, the greatest percentage of people spend the greatest percentage of their household budget. Now, if you're very wealthy, rising food prices don't impact you that much. But the poorer you are, the greater percentage of your income you spend on food. So if those prices are rising, that hurts you. Also, poorer people don't have cars. So lower gas prices don't mean jack to them because they're not driving anywhere anyway.
Yeah. I mean, and they can take these reports and essentially...
And if the stock market goes higher, that doesn't impact poor people either. They don't care.
No. There's nobody really that's poor that's investing in the stock market, period. They're not watching CNBC, MSNBC. They're not watching these shows. They don't care about whether pending home sales are up, down, or indifferent, right?
Because they're not buying any.
Right. They're not buying any of it. And this is back to my point, this class warfare that's essentially taking place. We got the poor and we got the rich. So it's the majority of the people fall in the first category, right?
Yep.
So they don't care about any of this stuff. But what do they care about? I can tell you what they care about. They care about getting their entitlement. They care about getting food stamps, welfare, whatever it may be. Now, like I always throw the
and they also want, Ryan, they want to keep the inflation number lower so that they don't have to pay them that much because all benefits are inflation adjusted. So if they tell them, hey, there's no inflation, well, guess what? You're not getting any more money from us.
Oh, yeah. I mean, just imagine. If we have deflation, Louis, then what are they going to cut their
benefits? Cut your benefits. Sure.
Yeah, they're going to cut your benefits back. So
don't think they won't do that. If they show CPI persistently negative for a year or so, they'll cut benefits by 1%.
Well, we have, moving on to the next thing that came out January 29th, pending home sales. Pending home sales fell negative 3.7% versus the estimate of 12.5% or 0.5%, which is, but hold on, this is still a 3.1% gain on a year-over-year basis. Now, my question to you is, Louis, obviously we know that December is not necessarily a great month for house shopping or buying or selling. So we would expect for it not to be, really a blockbuster number or anything in December. However, with interest rates as low as they possibly could be at this point in time, you would think that they would be, a reasonable number here, right?
Sure.
And we, time and time again, we're let down. We're let down because the market's promising us, just these huge things, that real estate is turning the corner, but it's not, guys. It's not. Now, Northern Virginia right now is a very hot market. I can tell before we've entered into the spring. And, Louis, I kind of told you that I felt like that this was going to happen coming into the spring. We would see that uptick. We've basically cleared out a lot of inventory heading into the spring market. Do I think that that's going to take place throughout the country? I think in major metropolitan areas it will. But I do know that it's going to be very price sensitive. I do think that people that have stable jobs, that have a good amount of disposable cash, which, like I said, there's not too many of those people, they probably are going to take the opportunity this year to buy. Do I think that that's going to really make the home prices rise? No. I think that the sales will kind of go up. I think maybe instead of the sellers having to give seller concessions, they might not have to give as much. Right. But I don't really think that that's going to push home prices higher. Does that make sense, Louis? Like, I feel like that people are going to price more conservatively to get their homes sold so they can move on and to wherever they're moving, whether it be a bigger home or downsizing. But I do think that the spring is going to be a decent spring for most of the major metropolitan areas. That's not for any other reason. Like I said, a lot of people have improved their equity positions. As we know, there was about 1/3 of the homes that have been underwater, and a lot of them are basically almost at a break even now. So if people can get out, they're going to try. We have interest rates that are ridiculously low. Like I remember at one point, Louis, we were like, how much lower can they go? We stopped talking about it because it just kept going lower, right? And you would think that everybody would be rushing to a mortgage company to try to get a mortgage. And they're not. And why would they not be? Because, well, they don't feel good about their situation. This is what the media pumps out there. The media says that it's the sentiment of the millennials out there that they just don't feel good about the times that we're living in right now, right? They don't feel confident enough to buy a house. But yet, National Association of Realtors is telling you that the number one place to market is the millennials.
Well, Gen Z, too.
Oh, yeah, and Gen Z. I mean,
it's coming up.
Well, when you're reaching, right? You're reaching big time. It kind of tells you all you need to know about the market. They're trying to coax people to buy homes that probably shouldn't be buying homes.
They need their sales and they need their prices to increase.
Yeah, I mean, they can't have pending home sales continue to fall from December to January to February to March. They'll get creative. And I've already seen, I don't know if you've been paying attention to this, but Fannie Mae, Freddie Mac, all of them are coming out now and saying, we really got to try to just start getting people into homes. What does that mean? Loosen underwriting guidelines. Okay, somebody got a job gap for 3 or 4 months? No big deal. Now, I'm not saying that that's what's taking place, but I think that that's what's coming.
Oh, that is what's coming.
That's what's coming.
Because, Ryan, the home and it's just like the labor participation rate is at multi-decade lows, the home ownership rate has gone nothing but straight down since 2005, 2006. So you can't call it a housing recovery. The home sales, pending home sales, new home sales are at multi-decade lows. Existing home sales are still at the 5 million mark. They don't have a housing recovery. They have it in price alone. And they're in the same predicament that the Fed is with the stock market. They need stock prices to go higher because that's all they have to say there's a recovery. Well, for a housing recovery, all the metrics are horrible other than at least, they're still eking out some price gains. But that's actually the worst thing for the housing market, Ryan, because if people's incomes aren't improving and the labor market isn't really improving because you got part-time jobs going to 55 years and older people who don't buy houses, they do not have a pipeline of potential home buyers. They keep touting the millennial and how Gen Z is on the way up. The 12 and 13-year-olds are going to give up video games to buy a home, all this kind of nonsense that they do to say that here comes the next wave of housing. Household formation is up, they're now saying, finally. That just means that millennials are moving out of their parents' basements and renting. So what? So basically, they have to do something to boost sales or at least to boost prices. It's a predicament because manipulating the housing market is far more difficult than manipulating the stock or gold or any other markets. There's no short selling of paper contracts. You can't do any of that stuff. You actually have to get real people to buy a real asset, and they have to have real money, or you got to give it to them or somehow boost home sales. It's very, very difficult to do, and we're seeing that this year. I don't even think maybe in those major metropolitan areas you might eke out a small price gain, but the home sales gross numbers, they're not going anywhere. And Ryan, the new home sales, they've overbuilt. In my area, most of the inventory is new home sales. It's priced very high. They haven't undergone price reductions, at least as are listed in the MLS. But I'm sure they're giving away, for the few homes that they do manage to sell, they're giving away incentives. So that's not going to help home prices if you've got this overhang of new construction.
Yeah, I agree with you. I mean, there's a lot of development spread around where I live, and I can kind of tell that if they're overbuilt, there's tons and tons of houses that are hitting the MLS that ordinarily wouldn't be on there. And I'm looking at the price points, and this is something we talked about before, Louis, where when you have new home sales prices that are in the same ballpark as resale, dollars per square foot and similar age, like let's just say that if a resale is 5-6 years old and you have a brand new house that's within 5 to 10% price of each other, and sometimes even closer than that, what's happening there? You know what I mean? More people are obviously going towards the new home, but that's hurting the resale then. And so I don't think I don't care about really anything that's to do with the housing numbers. And I tell people this all the time because they just laugh. Like most real estate agents are out there talking about average sales price, how many days on market, all these different things. Okay, great. But I really care about what's taking place on the economic front as far as people's wages and job stability and all these things. We know, Louis, that most of the jobs are being outsourced, right? They're contract jobs. They're not these long-term stable jobs being contracted out so people don't have to pay for benefits and insurance and stuff like that. But we're not seeing wages increase. We're not seeing companies become more productive. They're not increasing their bottom line profit. Stock price is going high. Great. That doesn't mean anything, though. And when you see this and you see the way that this bubble has been created and continues to be pumped and pumped and pumped, you know that it's going to end badly. It's just a matter of time. And unfortunately, I hope people protect themselves, because if you're listening to this show, then you know at some point that the majority, the herd that's been, the people that have been able to have their money in there, if they have retirement accounts, 401ks, Roth, whatever it may be, will position themselves for the future because it's not looking very good. I don't think, this is, to me, this is the last year if you're going to try to get a mortgage at a low fixed rate, to really do that as soon as possible. Because as you mentioned, Louis, anything could bust open. Yellen's already starting to recognize that there is global uncertainty, international fears, we've got Bullard out there running his mouth talking about, this is the St. Louis Fed president, talking about, you're already talking about a policy that is going to be slow-moving over the next couple of years against an economy that is going to run hot. Sorry, that was William Dudley, I believe. No, that was Bullard. It's going to run hot. What economy is he looking at? You know what he's looking at, Louis? He's looking at the stock market again. He has to be.
Yeah, well, no, he's also looking at the labor market and the supposed job gains that we have there, not looking behind the numbers that they're part-time jobs and that we've actually lost full-time jobs. They just see a top-line number increase. It's disingenuous for them to say, yes, we have labor market improving. They know they don't have wages improving. They can connect the dots. They know the labor participation rate isn't improving, but yet they want to continue to say the labor market's improving and the economy's improving. In fact, Yellen used our favorite word, Ryan. She said the economy is solid. We saw Reuters and AP start using that solid number for the last 2 or 3 months to talk about the economy. Instead of saying there's a recovery, they're just saying that the economy or the new numbers in the economy are solid. Now the Fed is saying that the economy is solid. And guess what, Ryan? If it's solid, raise the rate already.
Oh, absolutely.
Solid doesn't mean patience. Solid, if you think about the word solid, means it's firm, it's red, it can withstand shocks. It's solid. You don't wait. If you think the economy is solid, you can easily raise rates.
Right.
They're just talking and talking and talking.
Yeah, absolutely. And the talk is cheap. And I think that's more to the point of earlier when you said that at some point they're going to have to raise the rate because they can't continue to use the word solid and not do anything. They have to.
Well, it's kind of funny. They're trying to convince people that it's solid. They probably convinced themselves that it's solid, but yet they know that it's not. And eventually, people will start to realize that it's not. And that's what was one of our predictions for this year. A substantial minority of people realize, wait a minute, things aren't as good as the media is telling us, not just the people like Ryan and Lewis and the other people in the alternative media, because we've been promised a recovery for 6 years. At some point, people aren't stupid. And they realize, wait a minute, I still have a part-time job, or I don't have a job. Where's this recovery?
Right. Well, and what was it? I believe you sent me an article earlier this week on Case-Shiller, right? Case-Shiller Index?
Mm-hmm. And the article was titled "Recovery Has Barely Reached First Base," and it talks about the latest report from Case-Shiller showed a continued slowing of home price increases. November results for both the 10-city and 20-city composite index were lower on a year-over-year basis than October. I mean, this is what's been happening, and in a low interest rate environment where we still have. Keep in mind, Louis, many people don't know that there still is 100% financing out there that's available, right? And don't you think that there would be a much bigger home sales number if people could actually qualify, meaning that if they had a reasonable job, if they had a reasonable income, they could go and get 100% financing. It's out there. Sure.
Now, many people are going to say, well, the public just doesn't know that these programs exist. Like, they need to be educated, right? I don't think that that's the case because as a real estate agent myself, I would want to be talking that program up, right? Like, I would want people to know. So that would basically insinuate that the real estate agents don't know that these programs exist.
Well, I talked to some real estate agents, and I asked them how are they doing with that 3% down, and they said they didn't have any.
They don't have any.
Do you see people in your area looking to take advantage of the 3% Freddie Mac, Fannie Mae 3% down program?
Well, now that FHA has lowered their mortgage insurance back to the 0.85 monthly, that's going to be the cheaper way to go, just for overall payment standpoint than doing that Fannie or Freddie loans. The mortgage insurance is a little bit steeper.
Well, not for people who can't afford homes, though. That's what the 3% is for. I guess in your area maybe you don't have that clientele, but that was supposed to be the reason they were going to increase at least applications, not necessarily sales, was through this 3% down program.
And do you know why most of them won't fall into that category? I can tell you right now. Because the qualifying ratios, the debt-to-income ratios, are much more stringent on those loans.
Yeah, there you go. They're also for first-time home buyers, and if it's true that millennials are not as interested in buying a home, I think Peter Schiff pointed out the people that will go for the 3% are more likely to be scammers. People that realize, wait a minute, for $6,000, I can put down buy a $200,000 home, and then become what you call a first-time payment defaulter, and then just basically use that $6,000 as their rent payment for the next 2 or 3 years until they get kicked out.
Well, I already told you, when you buy a home, so we're in February, right? Let's say we write a contract to close in March. Your first payment isn't until May, right? Because when you close, especially if you have the seller paying your closing costs, the interest that you pay when you close would be to the end of that month. So you pay for basically all of April's interest potentially, March's interest when you close. If the seller's paying for it and you're giving the closing costs, you don't have to make a payment for essentially a month and a half, and then when you move in, you just don't make it, and then you stay there for who knows how long. A true story. So I have a transaction now where I don't think a payment has been made for over 3.5 years, and the house is still sitting. Okay.
Wonderful.
3.5 years. I don't know, and this is common. This is common. Like for you to just drive by and see basically abandoned houses sitting there, and they haven't been touched for years and years and years.
Okay, and that should be a lesson learned, that when you allow people to buy houses that clearly don't have the ability to pay, that's what's going to happen. And that's what the underlying premise of the 3% down is. Oh, you can't afford a house? Oh, yeah, you can, because you don't need any money. Just come up with $4,000, $5,000, $6,000, and you can buy a house. What do you think's going to happen there?
Well, and then it gets better. Oh, well, you don't have any reserves to show? Oh, that's okay. Just go ask your mommy and daddy to see if they'll throw in 2 months reserves in your bank account. We'll call it a gift, and then you can give it back to them later, right? I mean, it's
how to artificially boost the housing market.
Well, everything is artificially boosted, right? I mean, every single component of the economy is artificially boosted.
Except, you know what they can't do, Ryan? When they artificially boost the economy, all they can do is boost the price of existing assets. What we need are new assets, new production, which is investment. Investment doesn't pay. What pays is buying old assets that are going to rise in value, not because there's any new productive capacity or anything, or they're worth more. It's just that the price has been pushed higher. And that's where you make money in today's market. You buy existing assets that are just going to go up in value because of the cheap money.
Yep.
The reason people don't invest, the companies don't invest their cheap money that they have access to in improving their business, in capital expenditures, and hiring employees, there's no market. There's no opportunity for them to hit by doing that investment. So what do they do with the free money? They invest in the existing asset, which is their own stock. And they can make that price go higher. So that's the best return on investment you can get, Ryan. You take the money, you put it back in your own company, not in the form of improving the company or coming up with new products or services or hitting new markets. No, you put the money in to make the stock price of your company go higher. And it's the same with housing. You buy an old home and it rises in value. It's still the same home.
Yep.
What you don't see in this market is, even though I mentioned we have some new construction that isn't selling, and there's a reason for it, people can't afford it, but overall, new construction is at 30, 40-year lows. For us to have a recovery, a housing recovery, we want the new construction market to be booming. We have 350 million people in this country. We had 200 million people 30 years ago. There's the same amount of new construction.
Right. And the funny thing is about the new construction is that the people in control of these companies, the big builders,
mm-hmm.
they were assuming when they started building, because remember, a lot of the building that's taking place now is from the land that they bought years ago during the last boom and bust, right? That
right.
they couldn't start building on until it was feasible, meaning the price got to a level where it made sense for them to do so. Well, they knew that they were looking at the Fed and everything else, so all this took, they had to look at some statistics and stuff to make a decision to start building mass again. And I think what they looked at was, okay, looks like, we have low interest rates, so we have a good environment for people to buy homes. We've got the Fed basically doing whatever they want. The stock market's high. It looks like the economy's doing well. But they never really paid attention to the underlying fundamentals that actually would drive a real estate market, right?
Right.
And so they start building all these houses again, and they're wondering why buyers aren't knocking down their doors. Well, because they don't really exist. They don't. Because nobody decided...
How hard is that to figure out?
Yeah, nobody decided to question why they're not banging down the doors. I don't hear anybody talk about it. I don't hear anybody talk about it other than us, really. And it's because it's just simple. It's just simple. It's not because their mindset, like they're just scared to buy a house. It's not. If the consumer sentiment was really an indicator, the consumer sentiment, consumer confidence was 102.9, which is the best reading since 2007 and higher than the estimates of 95.0. Now, if we really gave a crap about that number, wouldn't it show where people were banging down builders' doors to buy houses?
Absolutely.
And we don't see any of that. We don't see money being pumped into, people running to the mall to buy up stuff with all their disposable cash and then coming home, with all the money that they're saving on their energy and buying more food with the prices that are already rising, and then going and knocking down the builder's door to buy a new home and then a new car. No, they're not.
No, actually, the car. There is a surge in the cars. But, the December personal spending just came out. And what do you think it is? It's negative 0.3.
Oh, that's pretty strong.
Okay, so they say got all this money saved from gas, not having to buy and pay $4 a gallon for gas. Gas prices are down, even though the crude oil is down 50%. They're down 30, 40%. So does it turn into spending? No. First of all, most people don't even have $500 in reserves. So they're going to save the $18 a month. They're going to go out and spend the $18 a month they saved on gas. No, they're going to use it to pay a little extra on their credit card. And that's about it. Or maybe they'll buy a pizza. They really, the people who give you these narratives that deflation is bad, they don't understand how people live. Lower prices are good. Lower prices drive demand. But when you see even lower gas prices not driving demand, it's not just like an isolation, gas prices are lower, the economy's better. They don't realize that gas prices, Ryan, being lower are an actual warning sign that something is terribly wrong with the economy. Instead, they're trying to make that out to be a positive, too. And the positive that they're claiming it out to be isn't even a positive because consumer spending isn't rising.
I know. Yeah.
So either way, it's not a positive that the gas prices are this low. It's a sign of a great distortion in the market, a lack of demand, and a potential disaster when all this blows up with the derivatives and the shale oil companies going bust. But still, they call this a positive, but it's not even a positive. It's not showing up in the numbers.
Well, and we talked about the derivatives, and if you guys didn't catch that episode, you can always go back and check out that previous episode on iTunes and or at Real Estate 360 Live. But yeah, the derivative thing is huge because, as we mentioned, that's a lagging thing. So we're not going to feel the effects of that for probably a couple more months. But I've already done a lot of reading on companies that are basically going out of business as we speak, right?
And your jobs are lost, and those are the good jobs. Well, but there are not enough good jobs. If they can lose those good jobs, as long as they're replaced by a few more part-time jobs, low-paying jobs, you could still have your jobs recovery, even though you lose all the good jobs.
But I think for last year, 2014, I believe it was almost like 40% of the jobs that were created were in the energy sector, right? 40%. So what happens if that just goes away?
Yeah, well, right now they haven't lost all of those jobs. They've lost some of those jobs, but in the overall mix, they still created more part-time jobs to make up for that loss. So you saw, that the initial jobless claims aren't that high. You'll see non-farm payroll come out. Maybe you'll see a change this Friday. But for the most part, like you say, it hasn't hit the numbers yet. The impact that the lower oil prices are having, nor have all the financial fallout from the Swiss depegging their franc to the euro, and Denmark may pull the same trick soon. They're also devaluing their krona to the euro. They may decide enough is enough and throw the towel in. Same with Greece. They're talking about, well, maybe Greece won't leave the euro. The Greeks are still asking, basically, for almost 100% debt forgiveness. Whatever they do, someone's going to take a haircut, and it's not, right now, it's clear, it's not going to be the Greeks. They've basically said, there's only so much we're going to pay, and you're going to have to go pound sand. Well, that's going to have an impact. All those bondholders aren't going to get paid 100% on the dollar, or maybe they won't get paid anything. We don't know yet, but once that falls in the train, that also has a knock-on effect, because banks hold that. It's not most of the Greek debt isn't held by Greeks. It's held by international banks, and they're the ones that are going to get hit. They were very greedy. They saw they had a higher yield on Greek debt, so they bought it. Well, with the high yield comes a risk. Risk just came home.
Well, and there's going to be more and more of these stories popping up, right? It's not going to just
Of course.
Portugal
can decide they've had enough. They don't want to pay. Once somebody sees Greece isn't paying, or there's a deal struck, you got other countries in Europe lined up for that party. Portugal, Ireland, Italy. Say, hey, why they get away with it? It's party time. Everybody gets a little debt relief. And then guess what? Oh, we have this QE program. We'll just buy all that garbage. So they'll just ECB will just tell everybody, buy back that debt. It's part of the QE program. And if that happens, you think the Fed is going to say, we're going to raise interest rates? No. They're going to have to start buying debt. And here's what I just thought of, Ryan. Obama's been going on and on trying to come up with ways to get money for infrastructure, right? He wants to get rid of the 529 college tax deduction. He gave up on that. He's looking for all kinds of ways, tax corporations, cash that they have overseas. He wants to do that, but he wants to pay for infrastructure. Well, if he can't get anything through Congress, right, maybe he won't sign an executive order. Maybe the Fed will say, oh, let's just buy bonds for infrastructure. It doesn't have to be QE. Yeah, we'll buy those bonds. They'll buy 80-90% of the newly issued infrastructure bonds.
Oh, of course. Let's just give them $1 trillion for infrastructure. Let's just donate.
Badly needed. And, the Fed loves that because they always say, we've done our job. We've printed our stuff. Now Congress has to act. Well, here's a case where Congress doesn't act. They can take the high road and say, hey, we'll buy those bonds too.
Right. Yeah. Well, and that's, and once again, they're grasping for straws here, right? Like it's okay. How do I find a way to make the economy, start running a little hot, as Bullard would say, right?
They don't realize it's not their job and they can't do it. The free market will take care of it. They just step back, but that's never going to happen.
No, and if they step back, it would be like basically the Depression, the Great Depression, all over.
It would be. It would be. You know why? Because all the malinvestment, all the bad stuff would collapse. Asset prices that shouldn't be so high, everything would collapse. But then, it's part of what they call the creative destruction, you would see a revival and money would go to where it should go, to where the demands are. Not to who's selecting the winner and what asset they want to rise. No. You would have a total collapse in most of the stock market, especially in companies that don't make any money. There's no reason for a company that doesn't make any money, that's been listed for 4 years, that continues to rise. That's only because of cheap money and there's nowhere else to put money. Well, but if you didn't have that, Ryan, then people would be looking for return on investment and capital would get allocated wisely in the hands of people who can actually make a profit from it.
Well, it's all a who you know game now, right? I mean, it's just like once you get
absolutely
one of those circles and you come up with a hot idea, it doesn't matter whether the product or service is going to be profitable. As long
can
as
I sell it to VC? Can VC sell it to Wall Street?
Absolutely, and then I think me and you agree.
And then can Wall Street sell it to the sucker in the hedge funds and the funds that are going to buy the stock? Sure, they can, because they've sold them that crap before and it went up, so it's not crap.
And it's crazy because I think that would be nice to see things rebuilt and actually rebuilt the way they should be built. You know what I mean? On sort of strong foundation, not something that's been mass manipulated for so many years now, and it gives people a false sense of what's taking place, which is that's the thing that makes me the most upset, is that what's going on is not reality. It's, for most people anyway. Now, if you're a big bank hedge fund or whoever it may be, then, venture capitalists, and you could be living large right now, but the majority of people don't have any money in the stock market, right?
Right.
So they're not participating in this upswing that we've had.
Not at all.
And they can't protect themselves even if they wanted to. If they wanted to be able to buy gold or silver or anything, they can't protect themselves there either. So,
well, the reason they can't, even if you can afford to buy gold or silver, they'll make sure to dissuade anybody from buying gold and silver because they knock the price down every time it goes up a little bit.
Well, and they've been doing
that. And they
have
done a great job, Ron. I put out a piece this morning that shows the gold coin sales are really low. I think they sold 50,000 one-ounce coins in January at the U.S. Mint, which is hardly anything, okay? It's about a ton and a half of gold. The Chinese Shanghai Gold Exchange, Ryan, sold 70 tons of gold, physical delivered gold, last week, and have delivered over 210 tons in the first 3 weeks of 2015. So that just tells you that the Asians, people in the East, are buying gold. And I don't even know if those 50,000 in the United States, those U.S. American Gold Eagles, were even sold to Americans. Assuming they were all sold to Americans, it's nothing.
Right.
The people in America, the gold line days of 2010 and 11 are over. They managed to squash that by the price went up. People bought ETFs, they bought gold coins, and now gold is a very hated asset class in the United States. But it's not. The demand in China, Russia, Turkey, India, still very high. It's increasing. Mm-hmm. But they don't want Americans to think that.
No, they basically have conditioned the majority of Americans to think that gold's not worth anything, really.
That's why you have Jackie on the show talking about how these people don't understand economics because the stock market is going up. What's funny is they even talk about the stock market going up when the last 7-8 months, gold has outperformed the stock market. They're still saying gold's having a tough time. No, it's not. Gold is up in every currency, including the U.S. dollar, in double digits in most instances. They're still talking about it being, a bad deal. Well, maybe now it's a trade, they'll say.
Mm-hmm. Yeah, and everybody's wondering, okay, well, it looks like the United States is not as bad as all these other countries. And you know what? It's just a byproduct.
We don't have an $18 trillion deficit. We don't have hundreds of trillions of dollars in unfunded liabilities. That's all gone away because the Fed stopped QE.
Well, you know what? They always pretend like it was never there, right?
That's unbelievable. The Federal Reserve was the most reckless central bank, maybe other than Japan, and now it's the strongest currency. Why? Because they stopped doing QE. We still have the deficits. The Fed still has a $4 or $5 trillion balance sheet of garbage.
Yeah.
Because they're talking about raising interest rates. That's the reason.
And to your point, back to the infrastructure thing, and they're trying to figure they can't balance the budget, they can't pass the budget, they don't have any clue of actually how to run a business. And when I'm talking about a business, I'm talking about the United States, right? They don't have a clue how to do that, so the only option for them is to go to, hey, Mr. Fed, I need you to open up your vaults again. Because you know what I mean? It's
one time only. This isn't QE.
Yeah, this will be called,
This will create jobs.
Absolutely. The infrastructure play, and I think that's why there's going to be that's the next big push, right?
They'll have a bridge collapse or something.
Oh, well, I mean, you figure. Yeah,
this shows that our infrastructure is decaying. Then there'll be pictures of places in the third world that have better bridges than we have, that kind of propaganda.
And you can obviously, put people back temporarily, and you go further in debt, but nobody cares about the debt. Debt doesn't even exist. No, you know why it doesn't matter? Because it hasn't mattered. They'll say, see, all you guys are talking about inflation, all you guys are talking about the debt imploding, the dollar collapsing, hasn't happened, so we'll just print more. Well, just imagine if the average home buyer was like, you know what, I don't care if I had $80,000 in debt. I'm not paying that back. Let me go buy a house real fast.
And you know why?
Right.
Because the debt collector hasn't caught up with them yet.
Right.
So
Yeah.
they haven't repoed one car. I'm going to go get another one on credit. And if they don't come and get the second one after they don't come and get the first one, I'll go get myself a third one as proof that it works.
Well, if you go to bankruptcy court and they ask you, what would happen? I'm just following the model of the United States.
Yeah.
Right? Do you think that's going to go over too well? No.
Yeah, no, because the judge is being paid with borrowed money.
Absolutely, and that's why I said it's the double standard that takes place is absurd, right? And you know what? You really want to prop up the economy or real estate, just start giving away houses. It might be smart. I mean, just start giving people money.
Well, they don't want to admit it, but that would be eventually, state-built housing. Instead of having these public housing that they put people in and they pay something, just build public housing and move people in, but give them the deed.
Well, the funny thing is we're laughing about that. I could actually see that happen.
Oh, absolutely. I think they did it in the UK, the council flats. They sold them. I think Thatcher did that. I think they sold some of them to the people living in them. But instead of selling them to them, lend them the money to buy them, and then have them pay it back.
Or first payment default.
Yeah, exactly.
Yeah, it's in reality.
Did both that way, because then somebody's saying, hey, I used to have to rent and live in this place. Now I own it. Thank you, government.
Well, and how are we ever going to convince people that, what's been taking place over the last 5 years, needs to stop and needs to change? And when
you can't. They thought it worked.
Right.
Right now, the propaganda is such that the United States has a recovery because of prudent central banking that took decisive action, did QE, did the stimulus, and avoided a financial calamity. Not realizing they caused the first potential calamity in 2008. Then they papered themselves out of it. But they haven't fixed anything. And if it collapses again, they're going to say, well, what we did last time to fix it was we printed more money. So that's why I think it's nonsense that if they do QE4, it's going to be a big game changer and everyone's going to rush into gold. No, they're not. Most people are going to cheer it on. The stock market's going to go higher. And the few people that think gold is going to go higher will buy it. But the gold and silver are dead in the United States. People are not interested in that as wealth preservation. They look to the Fed. The Fed has proven itself as being able to take care of the economy and the stock market. People don't watch a gold show, all day during the market like the way they do CNBC. There's a much bigger substantial audience for people that play the stock market than people that buy and trade gold and silver. In fact, most of the people that buy and trade gold and silver are the bullion banks manipulating the price in the first place. That's where the big trades are. It's not like an average guy sitting there trading contracts on COMEX all day.
No.
Because the person who's interested in gold and silver, really interested, doesn't trade COMEX contracts because they know those are just paper assets. They have their gold and silver in allocated vault somewhere in Singapore or Switzerland. Mm-hmm. And they're not trading.
Well, if they were to continue and we could get to QE 550, or the 500 round of it, then we'd probably see the Dow Jones at 100,000, right?
Right.
Because that's essentially what if this were to continue, if it didn't bust out at some point, and they were able to keep convincing people of the QE over and over, and just using different names because that's where they'll be creative, and then they'll start talking about it. Then they'll start talking about infrastructure to basically take people's attention from one area and put it on something else. If it did continue, then that's what we would have. We would have just stock market that just goes so far out of proportion. It's just a number, Louis. It doesn't matter what. It doesn't matter. 17,164. Doesn't matter if it's 800,468. It doesn't matter.
No, earnings don't matter. Debt doesn't matter. It's an old cliche until it does. And who knows when that'll be? I mean, for the .com, you had .com companies rising for 4 straight years with no earnings, and not even a potential to make earnings.
I know.
Until Barron's came out with the .bomb cover, and people were like, yeah, wait a minute. Why do I own this company? Because it has a .com at the end of the name, and it's never made any money, and its losses are increasing, and it's going to run out of cash soon?
Yeah.
It just takes a collective awareness that this isn't working.
Well,
but as long as it's working, then it's hard to tell people it's not. I mean, you know, if the stock market goes up and you make money, like Jackie said, people are making money. They may not understand, they may be wrong, but for 3 or 4 years, they've been right in a sense because the price of stocks have gone up.
Correct. And that's the only thing that people pay attention to is whether it's up or down, and that's it.
Correct.
And they're going to judge everything based upon just knowing that one thing, and it's crazy to me. But I guess that's why we have this show and we get to talk about all the other stuff, right?
That's right, Ryan.
Lewis, I appreciate you coming on as always. If you wouldn't
Thanks for having me.
A link to your blog so they can.
Oh, sure. Smallgold.com, SMAULGLD. As I mentioned, there's a latest blog post up there on gold demand in the U.S. versus China, and there's always something on the Federal Reserve, gold, silver, and real estate. So please check it out, smallgold.com. Thanks, Ryan, and thanks, everyone.
Thanks, Lewis. Thank you guys again for tuning in. Download, subscribe, share the show. Also, you can ask a question on the site at realestate360live.com. On the right-hand side, there's an Ask a Question button. Until next time, guys. Take care.